following content is a technical analysis on the Nasdaq 100 futures here off the daily interval. Well, we had some big headlines rock the markets across the space here, starting off with the economic data and the release of the producer price index that was lower, came out lower than expected, with also a decrease in initial jobless claims. And as a result, there was a significant increase in calls right across the entire market there. Treasuries once again saw a strong demand, particularly in the belly of the curve. Oil prices rose further due to the news that Libya's Shahara oil field will be temporarily shut down. And in addition to all of this, James Bullard, the prominent big member of the St. Louis Federal Reserve, announced his resignation and departure, where Bullard was well known for his hawkish stance, one of the biggest hawks within the Federal Reserve, of all the Federal Reserve members, wanting to have a quantitative tightening of $90 billion off the balance sheet. And so his departure suggested that he may have even potentially been pushed out. And it is likely that he will be replaced by an obedient, compliant dove, in my opinion. And the market responded positively to the news as well, causing prices to just rise all across the board. And I believe that the likelihood of, like I'd mentioned, not only challenging the new all-time highs, but also experiencing a substantial surge in equities between now and the end of the year has significantly increased, in my opinion. I mentioned this possibility in the previous video, and especially if we managed to surpass the significant resistance level and re-enter this multi-year primary trading range off the 2021 reactionary highs and reactionary lows across the board there. And we are now entering that space right now. And as of now, we had a nice clean drop. We called the top near-term top there, which was good for a 3.4% drop, especially if you're leveraged. As this came out, and we ended up backtesting that same significant point, put in a nice clean divergent high, ended up pulling back, whereas I added this new primary reactionary uptrend line off the beginnings of May reactionary lows there, and it was significantly bid from that inflection point. Ended up backtesting and having an additional reactionary low to it. Ended up challenging that primary reactionary high downtrend line off the 2020 reactionary highs there, and we popped that level. Bull traders, long traders, we ended up popping that level. So if you're back in short here, if not adding to your existing position here, you need to think about a scaling out process. If you're short, is it possible? It is always definitely possible that we could put in a marginal new high here, start to hone into the upside, maybe challenge that next leg of resistance, which I've added here at that 15,980.76 price resistance. That could spell for an initial bigger divergent high here for a much larger correction if we snap this primary reactionary uptrend line there. Short sellers, bear traders, they want to see a momentum fueled overshoot right back into this primary down trading range as a false breakout, trapping in a ton of bulls off that significant 15,486.30 price support and hone in right back and putting in a potential sell signal. Now, if they're not able to do that, and bull traders end up taking out this significant 15,980 price resistance, in my opinion, that's when you'll start to burn out these divergences. That could have been a potential negative divergences, where you already have a moving average convergence beginning, the beginning stages sequence of a bullish crossover there. So again, they also underlie significant technical momentum indicator inflection points, whereas we could just slip inside and avert that bullish crossover there. Then you'll have a hone to the downside. But again, the risk, it's all about gaining in and planning the trade and trading the plan, whereas you'll have a potential stop loss if you initiated that trade here, and you're already down underwater 1.5% here, up to 1590, call it a 3% and or potential 3% stop loss versus the reward of going back down to 1481, call it 1481 for a 4% drop down to 6.6. That would give you a 2-to-1 risk reward ratio back to the 618 fibs retracement, call it 14,439 price support. The bidding was heavy in this state, and every pullback was just bought up. But again, that is a significant breakout back into that trading range, only increasing the odds that we potentially get a further move back test. Bull traders, long traders, they need to defend this key level really at all costs there, and defend that level heavily, especially primary reactionary uptrend line here, really at all costs there, coinciding with that support zone range. And more than likely, the odds increase of breaking back into this primary trading range that you end up really testing right back up to that top of the primary trading range there. The odds just increase that you retest the top of the trading range, and if rejected pretty impulsively, that you will end up honing in right back to retest the bottom of the trading range, as we've seen here in 2021, where you had a nice rally all the way, bull flagging at the top of that trading range, ended up getting rejected really impulsively, and then melted right back down to the bottom of that trading range. Again, ended up happening again. We surged right off of it, back tested, put in a double bottom, and retested the top of that primary trading range once again. Ended up consolidating briefly and was rejected impulsively. Again, increasing the odds to retest that significant inflection point, back tested that 15,980 price resistance broke down, back tested the bottom of the range here once again, and it never looked back. We ended up selling off into a steep bear market there of 2022. And yeah, that's all I got there. But again, the longer you stay within this zone here, the odds just increase that you'll retest the top of the primary trading range. And if we do retest that trading range and bulls hold that key level inflection point, if we snap that level, if we pop that level and have a solid daily candle close above, the odds are significantly increased. That not only will you take out those new all-time high, those previous all-time highs of 2021, there is no resistance above, and that could mark the beginning stages of a breakout off that trough and just a much further, bigger rally to the upside before the year ends of 2023.